Hi everyone, welcome to this week's Business and Investment Tips program, a production of Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on staying invested in volatile times. Over time, markets go through ups and downs due to several factors. These factors include economic performance, companies' earnings, geopolitical tensions, changes in government policy, and more recently, inflationary pressures. Negative news usually sparks anxiety and causes investors to panic sell, locking in losses that create setbacks in their portfolio's return. For instance, in 2020, investors' worry was centered on the COVID-19 pandemic and its negative impact on economic growth, and by 2021, it was the new COVID-19 variant. Currently, markets are faced with the Russian-Ukraine war, which has heightened inflation fears and caused central banks to aggressively tighten interest rates. The fact is that volatility will always exist, therefore you should prepare for it throughout your financial journey. It is important to commit to a strategy for when markets are volatile. Here are 6 strategies to consider when volatility occurs. 1. Diversification. The golden rule for investing is never to put all your eggs in one basket. This means that you should spread out all your investments across various asset classes like stocks, money markets, bonds, and alternative assets. This helps you to minimize your risk and exposure to one asset class, particularly in the event of a market downturn. You should also understand the mix of the various asset classes in your portfolio and how they interact. By diversing, you create the potential for outperformance in your portfolio to compensate for the losses from other assets. For instance, investing in fixed income instruments like treasury bills, commercial papers, and savings bonds can help stabilize your portfolio when stocks are declining. However, as the market evolves, your portfolio may also need to change, as periods of volatility offer a great opportunity to reevaluate and perhaps rebalance your asset mix. This includes rotating into a new sector based on economic realities. 2. Asset allocation. To do this, you must simply decide what percentage of your portfolio to allocate to each asset class, considering they have different risk and return characteristics. An investor in their 20s has a higher risk capacity and can take on more risky investments. For instance, they can allocate 30% of their portfolio to fixed income instruments and the remaining 70% to risky investments like stocks, given that they can ride out market volatility over time. However, an investor nearing retirement should consider allocating over 70% of their portfolio to fixed income assets, as the primary goal for investing is capital preservation. Also, your risk appetite should play a major role in your asset allocation. If you have zero tolerance for risk, you should allocate significantly to fixed income assets than stocks. 3. Cost averaging. Predicting when stocks will bottom out might be difficult. Hence, it makes sense to invest a certain amount of money regularly, perhaps weekly or monthly, especially in volatile assets, instead of making a lump sum investment. With cost averaging, you can achieve a lower average cost, especially when the market is in a bearish trend. While this strategy does not guarantee protection against a market downturn, it helps you lower the risk of investing at a single point in time. 4. Spot fundamental stocks. When investing in risky assets like stocks, it is crucial to identify stocks with sound fundamentals trading at a price lower than their intrinsic value, which refers to the true value of a stock. These are well-established companies that generate stable earnings, have strong cash flows irrespective of the economic conditions, and have a promising outlook. It is important to note that periods of down markets present a great opportunity to acquire stocks with sound fundamentals, as these stocks are poised to recover when the market rebounds. 5. Adopt a long-term plan. According to historical evidence, investors are much less likely to suffer losses when investments are held for a longer period of time. It is therefore important to keep a long-term perspective when markets experience ups and downs. Investors should rather take advantage of market dips to purchase fundamentally sound stocks at deep discounts. 6. Have an emergency fund. It is important to build an emergency fund to ensure you can withstand potential market declines without selling. Spending from your emergency fund instead of selling assets as a loss in the event of a stock market decline is preferable. This is because stocks have consistently and historically rebounded to new highs after major market downturns. Do not hesitate to discuss your concerns with your financial advisor if you are worried about market volatility. They may review your financial plan with you, offer you expert advice, and assist you in deciding what actions you might need to take. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to info@getfinanceandinvestmenttips.com or send SMS to 0708 246 3747. Stay blessed.